to make it not comment through AI.
Okay, good morning, everyone. Spring is here, right?
Any changes?
Okay, so the goal for today is to wrap up Chapter 9. This will be the end of our substantive discussion on inbound planning, but for Chapter 11, which we will start today, which will be planning on the inbound front. So again, non-U.S. persons investing into the United States. We're going to start with a little more on the withholding side. So, first of all, we're going to talk about sales of U.S. real property. So, real estate. Okay, so think about land being permanently affixed to land. Always think of land as being something special. It's a finite resource. So, we have special rules because of the special nature of real property. So, U.S. real estate has traditionally been a popular investment for foreign investors. So, prior to your time, it caused a big uproar in the United States when we had some Japanese investors who bought Rockefeller Plaza right there in front of NBC of the Today Show, where the Christmas tree is and the ice skating rink and all of that. I don't know who owns it now. I think maybe it's changed hands a little bit, but it caused a little bit of an uproar in the United States. And we these iconic pieces of finite resource that are being owned by non-U.S. persons. So, out of that concern, generated what is called the Foreign Investment in Real Property Tax Act. One of my favorite acronyms, FIRPTA. So FIRPTA is a piece of legislation that deals with foreign investment into U.S. real estate and what happens when that foreign investor decides to exit that investment via the sale. Okay? So the point of the FIRPTA regime is to equate the tax treatment for gain on U.S. real estate transactions realized by U.S. and foreign investors. So we didn't want to cut off foreign investment in the United States. Why? Because we have plenty of U.S. investment in the foreign real estate on the outbound side, right? So we want to be careful of being too isolationist where we say, no, we can't have foreign investment of U.S. real property because inevitably that would hit us on the outbound investment from U.S. investment into foreign real property. So what this is just on the tax side, this is ensuring that gains on appreciation during a foreign owner's time of ownership is taxed in the United States, and it doesn't escape U.S. tax. And it equates a U.S. investor. If a U.S. investor owns U.S. real estate and they sell it years from now at a gain, they pay U.S. tax. So all we're trying to do is say the foreign person has to pay U.S. tax similarly, so we treat the two parties the same. So under FIRPTA, gains or losses realized by foreign investors from any sale, exchange, or other disposition of U.S. real property may otherwise be sourced foreign under the general residence of the seller rule, nonetheless incur U.S. tax in the same manner as income effectively connected with the U.S. business, i.e. gains incur tax at the normal rates of U.S. tax. So we didn't want to be stuck with having massive potential gains on an exit by a foreign investor in U.S. real estate escaping U.S. taxing jurisdiction by the normal sourcing rules where we look at seller's residence. Okay? But FIRPTA is an exception to that rule. It essentially treats the sale of U.S. real property as U.S. source, which makes the foreign person be subject to U.S. tax on any appreciation. Okay, 931. Anybody want it? I'll do it. Norma Marie Allen, she's doing a lot in our examples here. She is a non-resident alien individual whose only connection to the United States is ownership of some undeveloped land located in the United States. So she owns physical land in the United States. She owns the land as a passive investment. She eventually sells the land for a gain to a U.S. purchaser. prior to the enactment of FERPTA, any gain realized by NRA on the sale of land would be exempt from U.S. taxation. Foreign person, general rule is seller's residence. So the gain would be sourced foreign. We don't tax foreign source gains of foreign persons. Okay? Under FERPTA, the United States taxes NRA's gain on the sale of land in the same manner as effectively connected income with the conduct of a U.S. business, that is, on a net basis at the U.S. rates. Okay, so the two things we're looking for is, do we have U.S. real estate? Do I have a non-U.S. person selling that property? Doesn't matter who I sell it to. I could sell foreign to foreign. The new buyer could be a foreign individual, or the new buyer in this example could be a U.S. purchaser. That's irrelevant. All I simply need is U.S. real estate that's held by a non-U.S. person. And then that gain would be taxed in the United States. You might ask a question of how does the U.S. collect this tax? You're going to be collecting it via withholding tax on the purchase. Okay, so first we got to decide what is a U.S. real property interest. So what counts as real estate? It's very broad. You can imagine the U.S. writes the rules, power of the pen. It includes any interest in land and buildings, including a personal residence located in the United States. So undeveloped land, as a prior example, counts. Developed land, buildings attached to the land. It could be casinos. It could be office buildings. It could be Rockefeller Plaza. It could be a house that somebody owns. I had a question that I'll go through in a moment with a visiting professor who was here in the U.S. for a while and had a house that they bought. And were subsequently selling that house and going back to their home country. And the question came up about FERPTA, and we had to work through those rules to see what the implications were there. So, interestingly, so direct ownership. So this first one is direct ownership in real estate or anything permanently affects to it. A U.S. real property interest also includes ownership in a U.S. corporation. So stock doesn't sound at all like real estate, but if the underlying assets inside the corporation, the fair market value is greater than 50%, or sorry, at least 50% of total fair market value, then we consider that a U.S. real property holding. This is really like an anti-abuse rule. So if I told you the direct sale of real estate was subject to U.S. tax, but the sale of U.S. corporate stock was seller's residence, and it wouldn't take you very long to say, well, I should put my real estate in a U.S. corporation. And my exit strategy is to sell the stock of the U.S. corporation. That would be foreign source under the seller's residence rule, and I effectively avoid FERPTA. The U.S. is very wise to potential workarounds like that, so they have this U.S. real property holding company rule, which says if the more than half of the value of the corporate stock is comprised of underlying U.S. real property assets, then we're going to treat the stock as a real property, as a real property interest. Okay. This rule prevents from avoiding FERPTA by selling the stock instead of selling the underlying assets. And in addition, we have another anti-avoidance rule, which is a 5-year look-back rule that prevents the stuffing of non-real property assets to purposely fall below the 50% threshold close in time to selling the U.S. corporate stock. What could I do? I could say, okay, I understand that if greater than 50% of the value makes the corporate stock be a real property holding company, but what if I put a bunch of cash in there before the sale to purposely push the fair market value, the relative fair market value of the real estate below 50%? And I'm not in this rule. Back to the general rule of seller's residence for corporate stock. And if I put cash into a corporation and sell you the corporate stock, you're going to pay me dollar for dollar the amount of cash I put in there because you're buying stock has cash inside of it, right? So that would be easy workaround to the exception. So there's a 5-year look back period, which means if you've done any of that in the prior 5 years, then we are not going to count that as for purposes of the 50% tax. Why did they choose 5 years? That's an objective way to measure whether you were trying to stuff the corporation with non-real estate assets. The government sometimes does not want to get into a subjective argument with someone. Did you do this for this reason or that reason? If you did something 6 years ago in anticipation of an exit, the government kind of thinks, well, that's pretty extreme. You're willing to put assets in there and wait 5 years to sell it. That's indicative that you did it for a non-tax reason, right? If you did it 6 months ago, that's kind of, we're going to say that's a problem. So they chose 5 years to get to an objective test. Okay, 9.33.
That NRA is a non-resident alien whose only connection with the United States is the ownership of the shares of U.S. corporation U.S. Sub. U.S. Sub has $4 million of cash and a parcel of undeveloped land located in the United States with a fair market value of $6 million. Under FERPA, U.S. Sub is a U.S. real property holding corporation because over 50% of the fair market value of its assets constitutes a U.S. real property interest. And we get this because $6 million divided by $10 million.
So that means if NRA tries to exit this investment by a sale of U.S. Sub stock, the general seller's residence rule would be trumped by a terrible term, but he didn't make this rule, but trumped by the FERPA rules, which would say that no, this is a real property holding interest, therefore it's U.S. source, and I'm going to tax the gain on the sale of that stock. Okay.
Suppose that U.S. Sub had a $3.5 million mortgage securing the land in the United States, decreasing the land's net fair market value to $2.5 million. U.S. Sub's only other asset is still the cash of $4 million, such that U.S. Sub's fair market value is $6.5 million. U.S. Sub is no longer a U.S. real property holding corporation because less than 50% of the fair market value of its assets constitutes a U.S. real property interest. Because $2.5 million divided by $6.5 million equals 38%. And as a result, FERPA would not apply to the sale of U.S. Sub shares.
Which then means that the general rule would make the sale of stock seller's residence and be foreign source, not subject to U.S. tax. So binary, depending on whether you're 50% or not 50%. It's a fair market value test. Okay, thank you. 9.34 did Meta?
Okay, so there's a foreign corporation that owns a U.S. subsidiary whose asset for the last 5 years has been U.S. real estate with a basis of $1 million, and then the fair market value is $10 million. And so the foreign corporation is selling that sub and wants to avoid the rules. And so they add another $10.1 million of cash right before selling it. And so they sell it for $20.1 million, but because of that 5-year look-back rule, the U.S. Subs is still a U.S. real property holding corporation, and so they have to report a gain, and there's a withholding tax on it.
Yeah, so this is, again, when you see facts of like, I want to avoid a rule, that should perk things up, or if some client tells you they want to avoid a rule, so they're doing this, you should automatically look and see if there's something that's going to frustrate that intent. And putting cash in there that makes the fair market value go up dollar for dollar for the cash doesn't do anything to the amount of the gain. Because you get basis for the cash you put in, the value goes up by the like amount, so the gain stays the same. This is just saying you're still in the FERPA regime, even though you try to play around with the math to get below 50%. Okay? Now, if they did this 5 years ago in 1 day, they're okay. If it's 5 years or less, then it's a problem, and that's just the objective. Okay, so you might ask yourself, how do I collect this tax? Okay, there are really two ways, because taxing a foreign person in the United States, you can't tax their foreign operations, right? Foreign source income of a foreign person, none of the U.S.'s business, not subject to tax. So, if we have a U.S. purchaser, we can subject the purchaser, because they're the ones going to deliver the cash to the seller, we can make them withhold an amount of that on behalf of the foreign seller and remit that to the U.S. government. How do we make them do that? Just like what we were talking about before. If you don't withhold the right amount, or you don't withhold at all, you are the withholding agent as the U.S. purchaser. You are liable for the amount of the withholding that you did not collect and remit. Okay, so kind of a stick the U.S. government can put on the U.S. shareholder. The other way the U.S. can do this is it's obviously U.S. real property. So they can take the land, right? They can do whatever means they need to do because it's an asset held in the United States. So it's a way for them to access that, that property as well. So to ensure the collection of tax under FERPTA, the purchaser of U.S. real property interest withholds 15% of the purchase price and remits that to the U.S. government. Just like withholding tax and individual tax that the employer does, just like withholding tax on for that income that comes from the U.S. sources that we pay abroad. We're just putting the onus on the payor, the one who has the cash, instead of giving all of the cash to the seller, and the United States chasing the seller, the foreign seller, for the tax. We're going to make the U.S. purchaser withhold some of that tax. A lower withholding rate of 10% applies if the real property is a personal residence, so a home, with a value between $300,000 and $1 million. Sales of personal residences below $300,000 are exempt from withholding. This is the rule I had to go through with that visiting professor. Like, I had to ask them, well, how much are you selling your home for? And if you fall within that window, then you got a 10%. If you fall above that window, it's 15%. If you fall below the $300,000, it's not subject to withholding. Okay? And they were in the window, so they were between the amounts. And then the question became, well, how do I do this? How does this work? And we're going to talk about that tomorrow. So again, as the purchaser that fails to withhold is liable for the uncollected tax. So purchasers need to be careful to determine if withholding is required and whether the seller is a foreign person in this instance. So where this differs, if you have a U.S. to U.S. transaction of U.S. real estate, so U.S. seller to a U.S. buyer, there's no withholding, right? This is Foreign Investment in Real Property Tax Act. So you got to know who your seller is, right? And again, the onus is on you to collect, so you can't say, oh, I didn't know that person was a foreign person. Well, you have to do your diligence or get some evidence from that seller as to where they tax resident so that you can apply this rule, because if you don't do what is required of the rule, the government can come after you. They don't have to chase the foreign seller. They can just go straight to the U.S. And so, unlike what we talked about with the DAP income, remember like interest, dividends, and royalties that are U.S. sourced that get subject to withholding tax? In that instance, remember we talked about that's the final tax liability of the foreign person. You don't have to do anything else. You're subject to 10% withholding tax, 10% withholding, and you're done with the U.S. In this instance, the foreign seller, this is an advance, a prepayment, just like the individual tax setting where the employer withholds from you. That's not your final tax. You'll have to file a tax return, and you either claim a refund if you've prepaid too much, or you pay more if you haven't had a prepayment sufficient to meet your liability. Same thing here. So the foreign seller can file a tax return in the United States and say, here's my amount realized, here's my adjusted basis, here's my gain, and here's the tax. Either that's above or below the, say, 15% withholding that was done. If it's my actual tax is below what was withheld, I get a refund. If my actual tax is higher, I still owe more. So that in this instance, this is not the final transaction, the withholding, it's just a prepayment, just like the individual side. Okay. 9.32 is Kate.
Lisa, a Hungarian, owns farmland in the United States that she sells to Mr. Haney, a U.S. citizen, for $1 million. Mr. Haney is purchasing the U.S. real property interest with a value of $1 million and must therefore withhold 15% for $150,000. If the farmland had a growing corn crop worth $100,000, and Lisa sold the farmland with a growing corn crop to Mr. Haney for $1.1 million, Mr. Haney would then have to withhold $165,000.
So you just gotta go through your 2 steps. Do I have US real property? Yes. And this is saying it's farmland, so it would include the crops if there were crops on the farmland. And do I have a foreign seller? And the answer is yes. Now I have to withhold. Question would be is who's gonna help you do this? It would be an accountant who would probably help this person do this because this is someone who is buying the farmland. They probably don't know all the tax rules. So it might be them, it might be the attorney that's helping with the transaction as well. But somebody would flag this, hey, we got a foreign seller here, we have to withhold, then it becomes mechanical. How do I withhold and how do I remit that? Okay, thank you. Okay, 9.37, is somebody have that?
Norma Ray Allen, a citizen of a foreign country, comes to the United States to begin a new job on September 1st. NRA immediately purchases a house. However, on October 1st, before NRA has become a resident under either the substantial presence test or the green card test, NRA is fired and leaves the United States. NRA sells the house for $500,000, and the purchaser must withhold $50,000 of the sales price as 10% of the gross sales proceeds. And the sales price is between $300,000 and $1 million. If $50,000 exceeds the NRA's ultimate tax due, NRA can file a Form 1040-NR seeking a refund. If NRA's ultimate tax liability is greater than $50,000, NRA will owe additional tax.
Yep. So some interesting facts going on here. So this person, it says before this person has become a resident under the substantial presence test or the green card test. Remember, once they had substantial presence in the United States or obtained a green card, when they do that, they become a U.S. resident, right? So you'd say a U.S. person, and U.S. persons are subject to U.S. tax. If that were to happen before this sale, then we would have had a U.S. to U.S. transaction, no withholding. And of course, they would have had tax on the gain on the house. Then we do have some exclusion amounts on disposition of the house, if you remember from individuals. And then, as was mentioned, we're between the $300,000 and the $1 million, so we get the special 10% withholding tax rate on this. This form 1040 NR, that's 1040 non-resident, is what that means. But it looks exactly like the form 1040 if you remember. Income, expenses, those types of things. So this would require that subsequent filing depending on whether this 10% withholding is more or less than the actual amount due. Okay. So this is going to flow into our Chapter 7 material. So the impact of incurring U.S. tax for a foreign person. Okay. Whether that increases the global tax cost of a foreign person depends on the type of tax system the foreign person's home country utilizes to mitigate double taxation. Right? Remember, the United States, if we have a U.S. parent or U.S. person involved, we mitigate double taxation by foreign tax credit. That's rare in the world. Most other parts of the world mitigate double taxation by a territorial regime, meaning they just do not tax transactions that are outside of their country. Okay? So if the foreign person is resident of a country that employs a foreign tax credit like the U.S., then the foreign person's foreign tax cost, i.e. U.S. tax cost in this inbound setting, may be able, their foreign tax. The foreign person's foreign tax may be able to offset with a credit for any U.S. withholding tax. Right? Just like we were talking about with our foreign tax credit in the half A semester. If the foreign party if that country has a credit system, they pay U.S. tax, the foreign country will tax the same transaction but credit the U.S. tax against their foreign liability. Right? Make sure the person does not have 2 layers of tax on the same thing. So in these situations, if you reduce U.S. withholding tax, you're just replacing that with foreign tax. Right? Because you're paying one or the other. It's just the credit mechanism just mitigates the instance of double taxation. If you contrast that, if the foreign person is in a territorial system of taxation, any $1 of U.S. withholding tax is a cost. Because you're not going to get a credit in the foreign country because they're not even taxing the gain. Right? So you are incentivized to lower your withholding tax as much as possible. Right? That's the goal here. To lower the amount of withholding tax if you're in a territorial jurisdiction, because if not, that's just a global tax cost. Okay, so Chapter 9, we talked about FDAP income, so that's your interest, dividends, rents, royalties, those types of periodic payments from a passive investment in the United States. If the sourcing of that income, so hone in on what is the income we're talking about, what is the rule for sourcing that? If it's U.S., that outbound payment would be subject to withholding tax. The general rule is 30% under U.S. domestic law. I do have exceptions. Exceptions, portfolio interest, bank interest, those types of things can be accepted out where there's just no withholding. But if you are subject to withholding, you also can lower that rate from the 30% via tax treaties. And that just depends on the treaty between the United States and the country of which the foreign recipient person is a tax resident. And we talked about the withholding tax procedures of how that works. Today we talked about the special rules for U.S. real estate and the impacts of incurring U.S. tax on foreign persons. So the way to think about inbound planning or inbound investment in the United States is twofold. It's either active business in the United States, that's Chapter 10, that's subject to net basis taxation. Not any different than if it's a U.S. person doing that business. What's the income? Tax on the net amount at normal rates. And this topic of the more passive investment in the United States, where we're an investor, we're not doing business operations, we're just drawing a regular income stream. That's a withholding tax question. Okay. All right. So we're going to conclude our chapter, our inbound discussion with some planning. The way I like to do this is think about a representative evolution of investment in the United States. Usually investment into a foreign country, a new foreign country, is not I jump in with both feet, as an analogy. Meaning, I don't usually just start a brand new corporation and start immediately manufacturing and selling in a particular country. Why? Because one, I may not know a lot about that. Two, I may not be sure about how my product or my service is going to be received in that foreign country. So what I start doing is I start doing a little bit of activity. Then if that's successful, maybe I go to the next degree of investment. And I might ultimately end up having a foreign subsidiary corporation in that particular jurisdiction, but it takes me some time to get there, right? I want to learn the market. I want to learn about the customer in that market. I want to learn about the workforce in that market before I make a full-blown investment in that market. So I want to take you through an evolution of what that might look like. And that's not dissimilar from a U.S. investor abroad. It's the same issue. You don't know the market, you don't know the customers, you don't know all the logistics about that, so you don't jump in with both feet. Maybe you do a little bit over time until you're fully into the jurisdiction. Then we're going to talk about at what point do you trigger U.S. taxation. Okay? So when that investment in the U.S., think of it as an evolution again, at what point in that evolutionary timeline have I started doing enough in the United States where the U.S. says, now you're subject to U.S. tax? Okay? Not before, but now you've done enough to where I'm subject to U.S. tax. Then we're going to talk about alternatives for accessing the U.S. market and basics of inbound tax planning, and then we're going to wrap with a comprehensive example that kind of builds upon different case scenarios that I think goes really well in trying to round out your thinking about investing into the U.S. Okay, so there's a natural progression of U.S. market penetration by a foreign company that wishes to sell its products in the US. So you might start off selling products into the US via an independent distributor, right? I'm a foreign party, the US market's very attractive, obviously a large consumer market, very wealthy country. I might want to start introducing my products into the United States, and I choose to do that with an independent distributor. Somebody who already has the footprint and the scale in the United States to help. Okay? Alternatively, I could decide to license my product to another party who then uses that in the manufacturing and sales business to introduce my product to the market. That's a different model. Instead, I'm not the seller, I am the licensor of the idea and the product, and I do that in exchange for a royalty. Those are two ways where I can kind of extend myself into the US market without a lot of investment. We're going to talk about the pros and cons of doing this and the tax implications both in the United States and the foreign jurisdiction in a moment. The next step I might do is I might want to just bring that US importing and marketing in-house. Meaning, I want to start doing that myself, right? What does that do? That does two things. One, I get more of the profit in the supply chain. Because if I'm doing an independent distributor, or if I'm licensing the product, I'm losing some of the profit to that party that's doing that, right? The distributor is going to take their share of the profit in the transaction. The licensee is going to take their share of that in whatever they're doing in the transaction. So I might want to, over time, when I find out this is successful, my product sells in the United States, my service sells in the United States, I want to bring some of that in-house. And so that allows me to capture more profit. It might allow me to maintain the quality control that I want over the product, right? The delivery, the way the product is presented, the way the service happens to it, it might be better if I have control over that by virtue, instead of giving that to a third party. Okay? So I might have my own employees start coming to the United States to do that. They might identify customers, display inventory, negotiate sales, provide technical support. You can compare and contrast that to the earlier example. Now I'm starting to do a little bit more in the United States. Okay? And that's not a bad thing. I always caution my clients when they were nervous about how much they were doing. I'm like, well, you have to do whatever's best for your business. And don't be afraid if you do enough that subjects you to start being a U.S. taxpayer if that's good for your business, right? If you need to send people over and you get more sales, you get more customer contacts, you grow the business, it's not the end of the world for the U.S. to get a little slice of the pie, right, via tax. So don't let the tax tail wag the dog. You guys have heard me say that. So then I might establish a U.S. branch. If I start a U.S. branch, I might be hiring U.S.-based people, right? I might say, okay, I need a U.S. sales team. I need a U.S. Marketing team. And I want to do that, and I'm going to do that in a branch form. Remember, a branch is not a separate legal entity. It's a foreign person extending themselves into the country. But what you're doing now is you might have an office. You might have a fixed place of business, a warehouse, storage place for your product. Again, comparing that to sending people over, now you're doing something even more permanent in nature. You got people on the ground that are your employees doing stuff in the United States. You start seeing where that's going to get you further down the path of being a U.S. taxpayer. I might ultimately end up setting up a U.S. corporate subsidiary, right? Nissan has Nissan US, BMW has BMW US, right? Huge corporations on their own size, but they have US corporations that are every bit US operations as a US parented company, right? They have leadership, they have accounting functions, they have treasury functions, they have marketing, they have sales, they have manufacturing, all of that stuff going on inside these organizations, but that is a full-blown U.S. investment, right? Those companies are not dabbling in the U.S. market. This is not trying to see if Nissan product sells in the United States. They know it does. They are here long-term. But they might have, over time, gone back and you might have seen their first initial investment to be something above, in the above strategies. But that's a fully mature investment in the U.S. And you're obviously subject to U.S. tax if you have a U.S. corporation. Right? So we're going to go through each one of these and kind of explore just the nuances between the two, between all this. So a major issue for foreign company entering the U.S. is assessing at what point their U.S. activities trigger U.S. taxation. I say trigger it, at which point do you become a U.S. taxpayer, i.e. you need to file some form of a tax return and start paying tax into the U.S. government. Okay? That could raise your incremental global tax expense for the foreign person, depending on how the country of the investing foreign company taxes U.S. earnings. Are they a credit jurisdiction? Are they most likely a territorial jurisdiction? If they're territorial, they're not going to tax the U.S. activity. So if you do enough in the U.S. to where you trigger U.S. tax and become a U.S. taxpayer, that's going to increase your global tax burden. Again, not a bad thing. That just means you're becoming a global company at the end of the day. But just understand that that's going to raise the tax expense. At a minimum, if it doesn't raise your tax expense to something that's material, it is going to add to your incremental administrative costs. If you learned anything in our tax courses, it's not easy, right? Lots of rules to learn, lots of compliance to do. The foreign company is going to have to do that. How do they do that? They hire young people like you to help them. They hire young people like you that work for accounting firms. They hire young people like you that work for business consulting firms. Anything that whole compliance aspect has to be created. They have to pay for that. So even if it's the tax cost is not that much, just the mere compliance is something that has to be done. Okay? Whether a foreign company's U.S. activities trigger U.S. taxation depends on several factors, including the precise nature of the activities and the applicability of a tax treaty between the U.S. and the country of residence of the foreign company. Okay? So you need to understand exactly what are you doing. And these are very intrusive questions. If somebody were to come and ask me, like, I'm doing this and that, I'm going to ask them, like, well, what are your people doing? Are they visiting the United States? When they're in the United States, what are they doing in the United States? Are they visiting customers? Are they concluding contracts, signing contracts at the customer's location in the United States? How long do they stay in the United States? Are they getting paid in U.S. dollars? Those types of things are very, very important. And then you also just need to decide, well, what country is the foreign company and tax resident of? Where do they pay tax? Okay. There, I'm exploring whether there's a potential tax treaty between that country and the United States. If it's one of the traditional Western trading allies of the United States, there's going to be a tax treaty. All of Western Europe has treaties. Most of Asia has treaties with the United States. If that's the fact pattern you're dealing with, then I want to look at the treaty, because when we get to the Chapter 13 material, there'll be some provisions in there that'll talk specifically about how much activity can be done between the countries before you're subject to U.S. tax. That's the permanent establishment stuff we talked about earlier in Chapter 10. Is that degree of physical presence in the United States that would then drive U.S. taxation. Okay, so it becomes very intrusive. And the reason this gets a little complicated is because that's a snapshot in time, right? I've talked to numerous companies who said, oh, we don't have a U.S. tax liability because we do this and this. I'm like, well, when's the last time you really explored it? That might have been 2 years ago. Well, guess what? You hired more salespeople, and they're doing different things in the United States now. This is like a moving target, depending on how much you're doing in the United States. So those things never stay static, right? Business people are changing, new people get hired, starting to do different things. And again, it's not a bad thing to become subject to U.S. tax. I just like people to know about it ahead of time so that it could be in their financial projections and they can become compliant. You don't want to have somebody tell you that you became subject to U.S. tax 3 years ago and you haven't been filing tax returns. That's an administrative mess to try to get current on filing tax returns. So it's best that this point, okay, we all agree we're going to be a U.S. taxpayer, let's start filing, and from this point forward. That's not to say the U.S. wouldn't say it happened a year before, but at least you're starting somewhere. Okay, so let's go from the evolution from we do the least amount of touch to the United States to the most touch that we can possibly do from a business perspective in the United States. So let's say we're selling into the U.S. So I think of that as import sales. So the foreign party is importing the goods, getting them into the United States market. And let's say they're done by a foreign company to a U.S. customer, either directly or via an independent distributor. So I'm either selling my product and I put it on FedEx or DHL, and they ship it here to the United States and it lands on our doorstep. Or I sell it to a U.S. distributor and then they handle the logistics of it, right? So either one of those models, I'm just accessing the U.S. market, but I like to think of it as I'm lobbying my product over the border into the country without any real physical presence that I own in the United States, either via hard assets, property, land, buildings, offices, or people. I don't send people over either, right? How can we do this? Well, we have the internet. There's lots of websites that you can buy things from non-U.S. parties, and they have no physical connection to the United States besides there's drop shipping products in the United States. So I'm going to talk about each one of these things in terms of U.S. tax implications, and I'm going to give you a guess about the foreign tax implications. I can't give you definitive guidance on the foreign tax implications because it's going to vary by whatever country the foreign seller is in. This goes to the point that an international tax practitioner is not a global tax expert. You can't know the rules of every country in the world. You can have an inclination of what they are, but one reason why the big four accounting firms kind of dominate this space is because they have offices in all these countries. So if you came to me and you were from France, I could call France and say, okay, here's the transaction. How's this going to be taxed in your country? If you called me from China, I could call a China office and say, how is this going to be taxed in your country? But I'm going to give you some general thoughts as to what I think the answer is going to be in those things. So first, the U.S. tax implication. Import sales through an independent distributor or direct shipment via an unrelated shipping company should not create a taxable presence in the United States. Historically, the United States says that's not enough to become subject to U.S. tax. Now, you may have heard me talk about, and we're going to try to get to this at the end of this semester, the world lowering the threshold to something not needing physical presence to have a taxable presence. And that's because of U.S.-based technology companies being able to access other countries and customers in other countries very efficiently without having a physical presence in their country. The U.S. is somewhat hostile to lowering those thresholds, so in this instance, that works in favor of you as an inbound investor. Because the U.S. is not at the cutting edge of saying we need something lower than physical presence or people presence to have trigger of U.S. tax. If you do that, if this is an outbound context, you're going to have a whole different discussion with the country because they're hypersensitive to. And this is skewed because of the U.S. technology industry is largely, the technology industry is largely U.S. based. So that's why you have more on the outbound side than on the inbound side. You're an inbound company shipping in, drop shipping into the U.S. or sending in via an independent distributor, you're likely not going to be subject to U.S. tax. However, you sending your own employees into the U.S. in support of its import sales could create taxable presence in the United States depending on what those people are doing and the applicability of a tax treaty. Okay? So if you're shipping in, but you also have a salesperson kind of making the rounds in the United States, calling on customers, negotiating terms of contracts, signing contracts, those types of things, I'm gonna get more nervous about whether you have established a US presence in the United States. So again, this goes to the point of don't let this question hinder your growth in the United States. If that grows your bottom line, because you send a superstar salesperson over here that's drumming up business, make the pie bigger and give a slice to the US government. That's not a bad thing, right? Versus, I'm never gonna send anybody over and I'm just gonna hope people come to my website and order from me. Okay? Foreign tax implications. If you are selling product from a foreign location into the United States, I'm very confident you're gonna pay tax on the foreign side. Okay? That's just sales activity generates taxable transactions. And again, that's not a bad thing if you don't also subject yourself to US tax, because now you're paying one layer of tax on one profit stream. If you are also subjecting yourself to US tax, then it matters whether your foreign country is going to give you a credit for that to offset their tax on the transaction, or are they territorial, and now you do have double tax on one layer. Okay. Those are import sales. Let's say my model is not to directly send product in. I'm going to get my product into the US market by licensing my know-how, my expertise, my idea, my recipe, my technology to a US licensee. They're going to use that in their business to create sales and services. And they're going to pay me, say, 2% of that, or whatever the arm's length negotiated royalty rate is for that particular product. So I'm allowing them access to my intellectual property for a royalty stream. The US, so that's, what is that? That's FDAC, right? That's what we talked about in class 9, chapter 9. That's the outbound royalty payment. So a US licensee is going to pay a royalty to a foreign party. 30% withholding tax on the royalty is the general rule. Is there a tax treaty? What country are they tax resident in, and how does the 30% come down? And what is that? Foreign royalty income will likely result in foreign tax. I think if you have intellectual property owned in a foreign country and you license that out for royalty, I'm pretty confident most countries in the world are going to tax that royalty stream. So again, if you incur US withholding tax on that, may or may not be a cost to you depending on whether you get a credit offset against your foreign tax, or if they're territorial, it's just an incremental tax to you. Again, not a bad thing, you just need to know that going in on your economics of your transaction and your pricing. Okay, so let's say now my model has evolved to a point where I'm going to have a US branch operation. So I am going to actually start having some more regular physical presence in the United States. I might open up an office. I've done those prior things, and I'm like, yeah, hey, U.S. is going good. It's growing year over year. I'm going to make a real push into the U.S. So assuming that that branch activity is determined to constitute a business, okay? So remember, when I assess a branch, is it all facets of a business? Is it have income? Does it have expenses arriving at net income, or separate books and records maintained for that operation? Meaning it's sort of like a division, the U.S. division of the or is it a permanent establishment under the terms of a treaty? So it's either a branch, at which point it will be taxed, or is it a permanent residence, a fixed place of business in the United States? The foreign company will have a taxable presence in the United States, requiring the filing of a U.S. tax return and incurring tax at normal rates. If that's a foreign corporate owner, it'll be taxed at 21% in the U.S. Right? So that would be the 1120-F, corporate tax return for a foreign person. It looks exactly like the Form 1120 that every U.S. corporation files. Income, expenses, net taxable income times 21% is your tax liability. But you've done enough now to where you are a U.S. taxpayer. Right? You are operating in branch form. Foreign tax implications. The profits of the U.S. branch may not be subject to foreign tax currently under a territorial system of taxation commonly employed in foreign If, like most of the rest of the world, it's your foreign country is territorial, they're not gonna tax the US branch operations outside the United States. Okay. I put in the bubble here, you normally see branches as ovals. So, if I have a French company, I'd have a French box with a circle US inside the circle. That connotes that French company has a US branch in the United States. Either a physical location or employees coming to the United States executing contracts. Okay. So you can have one layer of taxation at 21%, and probably not subject to foreign tax. Okay, let's say I do that for a period of time, and now the business is fully going, fully functional, profitable. I'm deciding now it makes sense for me to have a U.S. corporation to do that operation. And so a U.S. subsidiary formed under U.S. state law, separate legal entity from its owner for U.S. and foreign tax purposes, right? Corporations are separate taxpayers. So now I just have a U.S. 1120, just like any other U.S.-based company. Nissan U.S., BMW U.S., they file 1120 for a U.S. corporation under state law. Obviously, that's a taxable presence. Every U.S. corporation is subject to U.S. tax simply by virtue of being formed as a corporation under state law. You're subject to U.S. tax, you're a U.S. person. So they have to file a tax return, and so you file your separate tax return. You pay tax at 21% on the earnings. Now you also have to layer in dividends. I like to think about any business investment, not just from stopping at the tax computation, but what are you going to do with the cash, right? I'm sure Nissan Japan and BMW Germany eventually want cash out of their U.S. operations, right? So think through how are you going to get money back to those places. That's going to be a big part of the cases that we talk about in this chapter. So if it's a corporation and your way of remitting earnings back to the foreign parent is a dividend, so you declare a dividend, pay the dividend, now you got to worry about withholding tax, right? Chapter 9 material, that's a FDAP source of income, dividends. Is that 30%? Or do you have a tax treaty between the U.S. and the country that the foreign person is a resident of? What does that bring it down to? What you find in many treaties is sometimes the withholding tax rate on dividends comes down to 0. So that may or may not be a cost to you. But you definitely want to understand that going in, because that would be a difference between operating as a branch. Potentially, you have the branch profits tax we talked about in half A. But you might want to just make sure you're understanding how the profits are going to be remitted back to the U.S. so you can layer on any U.S. withholding tax. Foreign tax implications. The profits will most likely not be subject to foreign tax currently or upon remittance in the form of a dividend under a territorial system of taxation. So the earnings will be clearly outside the foreign country's country. So in a territorial perspective, it wouldn't be subject to tax. And so any costs for U.S. income tax or dividend withholding tax is going to be a cost on the credit fees. And corporations, as you know, are boxes or rectangles on organs. So that circle we would have from the French parent into the U.S. would become a box. So if I'm comparing a U.S. branch with the U.S. corporation, they both incur tax at 21%, right? Because one's filing a Form 1120 as a U.S. corporation. The other one, the owner, is filing a tax return, an 1120F, for the U.S. branch operation, but the construct of the computing of the tax liability is exactly the same. What's the income associated with the U.S. operations? What's the expenses associated with it? That's the taxable income times 21%. So you're not going to get a lot of difference. You shouldn't get a lot of difference between what the amount of tax you're going to pay. And the withholding tax would be 30% for withholding on dividends in the corporate setting, or you'd have the branch profits tax, which could be 30% as well. Either one of those can both get lowered via an applicable tax treaty. So I don't really think operating in branch form versus corporate form is going to change your U.S. tax liability all that much at the end of the day. You're doing business in the U.S., the U.S. writes the rules that we want to collect the same amount of tax whether you're doing that in branch form or corporate form. Now, the tax advantages of a U.S. corporation include operating via a U.S. corporation can provide more control over when you incur the withholding tax on dividends, right? Because we only have a dividend when we declare a dividend and then pay a dividend. The board of directors of the subsidiary and the influence of sole shareholder and foreign parent on that board can really delay when a dividend is paid. And let's say you have a U.S. corporation and you're in growth mode, you're doing really well in the U.S., you may not be paying dividends for a number of years because you're investing all of the after-tax earnings back into the business to grow, right? And so you don't want to have that immediate cost of potential withholding tax. And so you got a lot of control over that because it requires board action to declare a dividend, right? Now, you can do the same thing in branch form because you remember how we computed branch profits tax? It was effectively looking at what a hypothetical dividend would be. And the way you looked at that was whether you had a reduction in your net equity in the branch. It's kind of like a dividend, right? That's what we'll call your net equity goes out. But it's just much cleaner, I think, because you have the board action that's required of the corporation. The separate legal status of a U.S. corporation may make it easier to justify management fees. So we're going to talk about transfer pricing later in this semester. Transfer pricing is intercompany transactions that must be priced at what you would charge a third party for a similar service. Parent companies really like to charge management fees to their subsidiaries. Many times it's justified. I think a lot of times it's subjective. Companies like to have it because the headquarters likes to say, well, we're supporting all the subsidiaries, we're doing all these valuable services, therefore they need to pay us some of their profits in the form of a management fee. Invariably, the jurisdiction that has the expense side of a management fee is skeptical of the amount of management fee that's paid. They always think the foreign office has this floated administrative structure that is sucking out management fees to subsidize high salaries, people not doing a whole lot. And so they've scrutinized the amount of management fees. Why? Because management fees are typically deductible in arriving at taxable income. And so they're going to have lower taxable income if there's a higher management fee charged to the subsidiary location. So I have found that if you have a U.S. corporation, it's much easier, even though it's still hard, to justify a management fee paid to a foreign parent compared to a branch operation that is going to compute their 1120F and then have a management fee coming out of that in that computation. It's just, you don't have the financial statements to kind of support the management fee in that. So you might have a little bit of better chance at sustaining your management fee deduction. And the big one is the sale of shares of a U.S. corporation is typically not subject to U.S. tax under the seller's residence rule, right? Foreign person selling U.S. corporate stock is seller's residence. Assuming that does not meet what we just talked about, the U.S. real property holding company, so it's not overly, its fair market value is not overly comprised of U.S. real estate, 50%. So if you've got a U.S. business that just does normal business activities, you're not going to run into the U.S. real property holding company because 50% of your value comprised of real estate is not typically not an issue for a true operating business. Your footprint has to be on some real estate that is pretty valuable, like oil is found underneath it, or you happen to be on a very nice location that somebody wants to build a golf course, or there's a coast or something like that. So a normal business does not run into the FERPTA rules we're talking about. So therefore you got a clean exit because you can sell the U.S. stock and have it be foreign source and not subject that to U.S. tax. So some subtle differences between choosing to stay in branch solution versus go into corporate solution. There are non-tax considerations deciding between operating in branch form versus U.S. corporate form. And basically, the biggest one is it insulates the foreign parent from legal liability issues that may be incurred by the U.S. operation. Here in my business entities course, we started talking about, at the start of that course, about different types of business entities. And there are tax differences, obviously, but there are non-tax differences. One of the biggest non-tax differences is the amount of legal liability that the owner has in the operation. If you put the operation in corporate form, the owner is only liable for the amount of their investment into the corporation. Worst case scenario, the corporation has a big problem, there's lawsuits, and people are looking for responsible parties. They can't go to the owners but for their investment in the stock. And so that might be important depending on what the business is that you're doing. If the U.S. business is in transportation, or if it's in a chemical field, or something that maybe has an exposure to liabilities, you might want to do that in U.S. corporate form so that there's not liability to the foreign parent. Whereas if you did that in branch form, there is no liability protection from a branch. Right? A foreign owner can be fully liable for the activities of the foreign branch if there's a problem. So, depending on what business is being conducted, you might want that protection. A U.S. branch may be easier to operate from an administrative standpoint because you're not paying a lawyer, you're not to form the corporation, you don't have all the administrative paperwork with the state to stay in good standing with the state as a corporation. So it just might be, and I would say this is slightly easier. Because again, I kind of view administration as, well, somebody's got to do it, but it's not insurmountable to do that. But a branch operation is slightly easier to maintain than a corporation. And a U.S. corporation may make it easier to involve U.S. persons in the business venture, as the U.S. corporation can issue shares directly to such investors in exchange for their investment. So let's say one of my growth initiatives in the U.S. becomes I need to add a second owner, and it's a U.S. partner, a U.S. Investor into the business. If I have a U.S. corporation, I can issue shares to that new investor. We have to decide how many shares for how much of an investment, but that's pretty straightforward for that investor. Whereas if I have a branch, adding a second owner to the branch makes that branch a partnership. And that may or may not be an issue, but I have to then form a partnership agreement to articulate how we're going to share responsibilities of the partnership, profits and losses and all that stuff. It might be easier just giving them shares. So that may or may not be an issue depending on your business model. Do you anticipate ever having a U.S. investor into your business? And that just depends on the particular business application. Okay. I want to talk about some basics of inbound tax planning. So, dividends from a U.S. subsidiary corporation to its foreign parent is a common way to distribute the earnings from the U.S. subsidiary to the foreign parent. Right? Absent any other way to get profits from a U.S. corporation to the foreign parent, it has to be a dividend. No other way to send the funds up to the parent. It has to be a board action, declare a dividend, and dividends paid. Importantly, for a U.S. corporation, dividends are not deductible when computing the distributing corporation's U.S. corporate income tax liability. So in business entities, when we computed the corporate tax liability, we never at one point deducted dividends. Dividends are an after-tax cash distribution. They are not deductible in arriving at taxable income. So although dividends may be subject to a lower rate of U.S. withholding tax than provided under domestic law, 30% is the general rule, with some treaties reducing the tax rate to 0%. So I do have withholding I got to think about, and I don't get a deduction for the dividend. Foreign tax implications: most foreign foreign countries exempt dividends received because they're in a territorial jurisdiction, and so they view that dividend as being sourced from not within their country. Therefore, any U.S. withholding tax I incur, as we talked about earlier, represents incremental global tax expense. Okay? So, dividends are not the most efficient way to distribute profits because I don't get a deduction on the distribution. I have a tax distribution, and if I do layer on some U.S. withholding tax on that, that's incremental cost to the operation. So if I contrast that with debt planning, meaning that what if I finance my U.S. subsidiary with some intercompany debt as opposed to doing 100% equity finance? So as I don't have any knowledge of this because I've never worked on these accounts, but let's say BMW US, I had the option of starting that operation with 100% equity investment from BMW Germany, or I could do part debt, loan it money, and part equity. Now I have two possible mechanisms to distribute cash from the United States to the US. One, if somebody loans me money, I have to pay them interest. And I can always declare a dividend that we just talked about. But now I have a second option. I can pay interest. So, in debt planning, U.S. interest expense is deductible in arriving at U.S. corporate income tax expense, whereas dividends are not. Now I can repatriate cash from the U.S. to Germany with a deductible payment. U.S. interest owed to a foreign person, foreign shareholder may be subject to lower withholding tax than would otherwise be incurred on dividends. When you look at tax treaties, a lot of times the withholding tax rate on interest is lower than the withholding tax rate on dividends. The purported debt must be considered debt under U.S. tax principles. So it has to be debt. I have to view it from a third-party situation. Would a third party lend this amount of money to this borrower on their credit worthiness at this interest rate? That's the test I'm held to. Okay? And I also have to do the 163J limitations. We're business entities, you know, we have a limitation on the amount of interest expense that a U.S. corporation can take. That is 30% of EBITDA. So I can pay more interest than that, but I can only deduct 30% of EBITDA. If I pay more than that limitation, then the excess carries forward to future years. I have to have more EBITDA or less interest expense to use it in the future years. Okay? And the BEAT implications, remember we had the BEAT regime from half A, and that's for all deductible expenses. That's a minimum tax regime in the United States. So whatever I do deduct under 163J, it also has to run through the BEAT calculation as well to see if I'm paying the minimum amount of tax. So there's more hurdles for this because it is a deductible expense. So the U.S. is obviously interested in that compared to dividends. Dividends are not deductible. Foreign tax implications. Interest income to the foreign lender will nearly always result from foreign tax. So compare and contrast that to the dividend where I said they may not tax the dividend because the earnings were created offshore. If the foreign parent is lending money to the U.S. and gets interest, I'm pretty confident most countries are going to tax that interest income. So you get a deduction coming out of the U.S., but it's taxable in the foreign parent jurisdiction, but I might have lower withholding tax. You can see where all of this comes to modeling. You gotta model different scenarios, and you don't do that just once. You do that throughout the lifeline of the evolution of the business. And you're always trying to get down to the lowest amount of tax that accomplishes the business objective. Right? I don't want to not grow sales because it's just going to trigger U.S. tax. I want to try to maximize the return on an after-tax basis. And I put here the interest rate assessed on the intercompany lending is subject to transfer pricing scrutiny. So I would have to understand what is the pricing of that debt. And I can't charge more of an interest rate than the market because it's being paid intercompany to the foreign parent. I'm held to what would be the interest rate assessed by a bank on lending on similar terms to that. Okay, let's say I did royalty planning. So it may be advantageous to license intellectual property owned by the foreign parent to the U.S. subsidiary in exchange for a royalty. So I could do that in place of the debt planning. I could do it in addition to the debt planning. And now this is a third option to repatriate money from the U.S. to the foreign parent because I can pay a royalty out. And royalty expense is generally deductible against U.S. corporate income tax liability. Royalty is an expense. If you're using it in your business, that royalty expense is a deductible expense. Now, it would have to run through the BEAT regime. The BEAT regime applies to all deductible payments. If you go back and look at your notes, I don't have a 163J equivalent for the royalty that I have for interest. Right? So all I have to do is make sure that I'm not subject to BEAT. I'm doing my calculations here. And U.S. withholding tax is up to that payment from the U.S., including the applicability of a tax treaty. And that royalty rate is going to be subject to transfer pricing. I can't do a higher or lower than market royalty rate. I'm held to what would a third-party licensor license this intellectual property and charge the licensee for that. And the royalty income to the foreign licensor will likely result in incremental foreign tax. This is very similar to interest expense. Royalty expense is very similar, deductible. Doesn't have a 163J, but it does go through the BEAT regime. It's probably taxable in the foreign interest. Both subject to transfer pricing. I can do management fee planning. You can see these are all trying to get funds out of the United States to the foreign jurisdiction in a deductible payment. Interest, royalties, management fees. So, assuming you have the proper factual support that there is actually a management service being provided, that's the transfer pricing scrutiny. There has to be a real need for the management service. So you can't have a U.S. operation that has fully functioning CEO, CFO, administration, IT, legal, treasury, everything. Why are you paying the foreign parent? You have all that here, right? So there has to be a real service being provided that gives rise to the management fee. But if that's your facts, then management fees are generally deductible. Deduction in arriving at taxable income, assuming they pass the transfer pricing mechanics. And they typically do not incur withholding tax. So you can get a management fee out of the United States without a withholding tax. It doesn't have the same FDAP nature as dividends, interest, rents, and royalties. Now, the BEAT regime does apply. Right? All BEAT applies to all deductible payments to your foreign party. So the management fee have to go into that calculation, and I have to price it according to transfer pricing. What would a third party charge for those IT services? They were providing those to that U.S. subsidiary. Management fees received by a foreign parent company will most likely result in incremental foreign tax. So the receipt of that on the parent company side is going to be subject to foreign tax. Transfer pricing. So with the exception of dividend planning, the above mentioned repatriation planning implicates transfer pricing, meaning setting of an interest rate on intercompany loans, the establishment of the royalty rate for a license of intellectual property, and the pricing of management fees must be arm's length. That standard, the arm's length standard, is what that's saying is a related party can't charge more or less than what an unrelated party would have charged for the same service. Okay? U.S. corporation paying those types of payments must establish a defensible position for the amounts charged, and you do that by having contemporaneous documentation of the transfer pricing methodology. So all the big four accounting firms have transfer pricing practices. There are transfer pricing partners in those firms. That's all they do is this stuff. There are specialty transfer pricing firms out there that just do transfer pricing. But what they're doing is saying, okay, you're paying this amount of royalty to your foreign parent. I will go out and do searches of what unrelated persons charge for access to similar technology on similar terms. And I will create a document that gives you a range of what that is. And say it's 3 to 5% of sales. And then you would use that as your defense if anyone, foreign parent jurisdiction or the US jurisdiction, audits that transaction and says, why did you pick 4%? That seems high. You would say, oh, here's my analysis, here's my report. And then what that does is puts the burden on the audit side, on the governmental audit side, to do their own analysis. And my experience has been, if you hand an auditor a pretty thick sheet, pretty thick report, he's like, okay, I'm not going to go and create my own report. You paid a lot of money for this, and I assume that work's been done correctly. Now, that doesn't mean they always do that. There are some pretty famous transfer pricing cases out there. They're usually big, big dollars at stake. When we get to the transfer pricing material, I'll talk about some of those, but they're like in the billions of dollars of tax. And these court cases go on for long periods of time because of how you stake. But that's how you support your transfer pricing, is you do analysis on what a third party would charge, and then you charge accordingly. An arm's length amount is typically phrased in terms of a range, so it's usually never, the report never says it's this, it's usually between this and this. In my discussions with transfer pricing people, is any point within that range is as good as any other point. So you might have a little bit of ability to influence the profit stream by going to the lower end or the higher end of that range. Okay. We will pick up with the comprehensive example on Monday. I want to go through them all kind of sequentially, because I think they all build upon each other. If you haven't volunteered for one, I'd ask you to think about volunteering for one. But we're going to go through and apply all of these things we just talked about. Different types of repatriation, different types of withholding tax rates, and then we're going to be thinking about the global tax burden. I think that's the way you got to think about this thing. Companies are interested in, what do I pay tax globally and all the way through the transaction. So think about how cash gets back to the parent. Okay, I will send you a note tomorrow about what we're going to do next week as well. We'll start the chapter. Okay, thank you.
What? Yeah, the water.
Signing sheet?
Oh, my buddy watches was crazy. I'm not a baseball guy, but I know, me neither. I missed out. I watched the hockey game, obviously, but I was can't miss that. But.